Most people think cash is the safest part of their life. I think that belief gets people hurt. Cash does not disappear because the stock market has a bad year. Cash disappears when one door controls all of it, and that door does not open. That is what 1929 taught. Not as an old history lesson, as a warning label. 9,000 American banks failed. Ordinary depositors did not lose because they were greedy. They lost because they trusted a structure they did not understand. If your entire cash life depends on one institution opening tomorrow morning, you do not have safety. You have dependency. I have spent my life studying one very simple truth. The first rule of money is not return, it is survivability. If you cannot survive the interruption, the rest of the conversation is theater. So I want to show you what most people are never taught. I want to show you where cash actually dies, and I want to show you the structure that kept some people alive in 1929, then translate that structure into the tools that still exist right now. The whole story fits inside one image. A locked door, that is the mother line. That is the only line that matters. If one locked door can freeze your life, then your money is not stored. It is trapped. People like to argue about interest rates, diversification, market timing, recession odds, and the latest headline out of Washington. I pay attention to something more brutal. I ask a simpler question. If the system pauses for 72 hours, who still has options? That question cuts through almost every illusion in personal finance. A great many people believe they have cash because they can see a number on a screen. I do not count that as cash. I count that as access under normal conditions. Normal conditions are not a contract. Normal conditions are a mood, and moods change very fast in finance. The mother line never changes. One locked door can ruin a disciplined person just as fast as it ruins a reckless one. That is why I want to begin in the harshest possible place. Not with yield, not with convenience, not with the comforting language banks use when they want you to feel modern and protected and permanently connected. I want to begin with the moment the door does not open. In the early years of the Depression, people walked to banks that had been standing in their towns for decades. They were not speculators. They were not gamblers. They were not trying to beat the market. They were doing what every sensible adult was told to do. Save the cash, put it in the bank. Be responsible. Then the sign went up, closed. That single word destroyed families faster than any stock chart ever could. 9,000 banks failed between 1930 and 1933. That number should hit you like a hammer because it means the disaster was not local. It was structural. And the men and women who got trapped were not fools. They were rule followers. That is what makes this dangerous. When a reckless person loses money, the public learns the wrong lesson. It says the victim was irresponsible. When a disciplined person loses money inside a respectable institution, the real lesson appears. Structure beats intention. That is the first mechanism. I call it the liability swap. The moment you deposit money in a bank, your cash stops being your property in the practical sense that matters during stress. It becomes the bank's liability to you. One sentence, that is the whole mechanism. You think you stored an asset. In reality, you accepted a promise, and once you understand that, the screen on your phone looks different. If you have $200,000 in a bank, most people say you own $200,000 of cash. I say you own a claim. That claim is only as good as the structure standing behind it. In calm periods, the distinction feels boring. In stressed periods, it becomes the entire story. The math is not hard. A bank takes short-term deposits and puts them into longer assets, mortgages, loans, securities, private deals, commercial real estate. That mismatch works until too many people want their money now. Then the locked door appears. That is not ancient history. That is banking logic. The details change. The software improves. The app looks cleaner. The marketing gets warmer. The mismatch does not change. And once you see the liability swap clearly, a second mechanism becomes unavoidable. I call it the brand trap. Most people decide where to store cash the way children choose cereal. They trust the familiar name, the polished branch, the professional logo, the nice mobile app, the feeling of scale. They think the big brand means the strong structure. I do not. Structure matters more than brand always. That was true in 1929. It is true now. During the banking failures of the Depression, not all institutions collapsed at the same rate. Some structures were built to serve depositors first. Others were built to serve profit first. The difference looked invisible in good times and bad times. It became life or death. That is one of the most expensive blind spots in the whole money world. People assume every place that holds deposits is basically the same. They are not the same. A shareholder-owned commercial bank and a member-owned credit union do not begin from the same incentives. That sentence sounds dry. It is not dry when your cash depends on it. A shareholder system is pushed by return on equity, a depositor. First system is pulled toward member protection. Those two motives can sit quietly beside each other for years. Then stress arrives and the motives separate. This is why I do not want people to ask only, is my bank large? I want them to ask, what is the structure? Who is it built to serve first? What balance sheet pressure lives underneath the brand? The survivors of 1929 did not possess supernatural foresight. Many of them simply stood in different structures before the panic spread. That is not prediction. That is positioning. And positioning is the cheapest form of intelligence. Now let me make this personal. If all your cash sits in one commercial bank because it is convenient, because the branch is close, because your paycheck lands there, because your bills auto-draft there, because changing anything feels annoying, then you are not acting like an investor. You are acting like a captive. That is the identity flip. A person with one bank and one door is not conservative. He is exposed. A person with multiple layers is not paranoid. He is functional. I want that sentence to stick because many people have been taught to confuse convenience with prudence. Those are not twins. Often they are enemies. Convenience compresses your options into one place. Prudence spreads your options across different failure paths. That leads to the third mechanism. I call it the insurance ceiling. Deposit insurance is real. It matters. It has saved many people from localized failures, but people speak about it as if it were a concrete bunker. I think of it as a line on the floor. Useful line, not fortress. The difference matters. The conventional comfort phrase is simple. My money is insured. That phrase hides three deeper questions. Insured by whom? Insured to what amount? Insured under what conditions when multiple failures hit at once? If you hold more than the insured limit inside one ownership category at one bank, you are not being cautious. You are choosing to stand past the line. And even if you stay under the line, you still need to understand what the line is and what it is not. Insurance is strongest when the failures are scattered and manageable. Insurance becomes political. When the failures become systemic, those are not the same environment. The source document you gave me points to something else that should make any serious saver sit up straight. In 2026, we already saw a bank fail. At the same time, there has been open discussion about restructuring or weakening the federal insurance apparatus, and lawmakers have argued over raising coverage limits dramatically. I do not need to predict the exact next event to understand the signal. When the people inside the system start debating the size, shape, or future of the protection wall, I pay attention, not because collapse is guaranteed, because complacency is no longer justified. The smart response is not panic, it is architecture. And architecture begins with an uncomfortable rule. No single layer should carry your entire life. That is the heart of the 1929 strategy. It was never about making one perfect bet on one perfect institution. It was about refusing to let one locked door own your household. Once you understand that, your cash stops being one pile. It becomes a system. I want to give you that system now, not as theory, as an operating protocol. But before I do, there is one more mechanism you need to see, because without it, people implement the system badly. I call it the time gap in a crisis. Your problem is often not insolvency first. It is interruption first. That is why otherwise intelligent people make stupid moves under stress. They wait until access is broken, then they try to redesign their life in real time. Real time is the worst time. The people who looked smart in 1929 were usually not smarter in the moment. They were earlier. That is all earlier. They moved before the crowd knew why moving mattered. The 1929 strategy was a time strategy as much as a storage strategy. By the time the sign on the door appears, the useful decisions are mostly gone. You want to build before the break, not during it. And that brings me to the structure: 4 layers, 1 mother line. No single locked door. The first layer is what I call utility cash. This is the money for ordinary life. Paychecks, rent, mortgage, groceries, utilities, card payments, automatic drafts. The machine of the month, you keep it in a federally insured account at a large institution because daily life needs plumbing. But here is the discipline: you do not confuse plumbing with protection. That account is a tool, not a fortress, not a life raft, a tool. I want most people to hold only what the household needs for near-term operation there. Often that means 1 month, maybe 2, depending on how income arrives and bills land. Not every spare dollar. Not the whole emergency fund. Not the cash earmarked for taxes, tuition, or a home down payment if that pushes you into concentration. Utility cash solves movement. It does not solve survival. That distinction sounds small until the door locks. Here is the numeric discipline. If your household spends $8,000 a month and your bill cycle is predictable, maybe you keep 1 to 2 months there, 8 to 16,000. Maybe a bit more if your business has lumpy flows, but not 300,000, because the interface feels nice and the direct deposit is easy. That is how adults accidentally become hostages. The example is ordinary. A family keeps everything in the same national bank because the mortgage, the cards, the payroll, and the checking account all live there. Nothing feels wrong for years. Then a regional event, a system outage, a fraud freeze, a temporary closure, or a run-driven delay hits. Even if the family eventually gets every insured dollar back, the immediate problem appears first: bills, payroll, access, motion, utility. Cash is for motion, so keep it sized for motion. No more. The second layer is what I call structure cash. This is where the brand trap dies. You place secondary reserves in a structurally different institution, often a credit union, because I want a different ownership model and a separate federal insurance channel. That point is important. Separate means separate. If a commercial bank gives you one insurance framework and a credit union gives you another, you are not duplicating risk. You are splitting it along legal lines that were designed to stand apart. That is not a trick. That is what intelligent adults do when they finally stop worshiping convenience. Suppose you keep $50,000 of emergency reserves. I do not want that entire reserve parked behind the same kind of door with the same kind of incentives and the same kind of insurance wrapper as your operating cash. I want another lane. That second lane matters psychologically as much as financially. When one lane stalls, your brain stays calm because the whole household is not trapped inside a single yes or no. A member-owned structure is not magic. It can still make mistakes. It can still fail. Do not turn a credit union into a religion. That is not the point. The point is structural diversity. Commercial bank here, credit union there. Different incentives, different wrapper, different lane. The harsher judgment is simple. A person who keeps all liquid reserves in one banking species has not diversified. He has decorated concentration. Now the third layer, this is where many people feel clever and become careless. I call it bridge cash. Physical cash outside the bank is not a replacement for a financial system. It is a bridge over a temporary break in the system. The instinct is correct. The scale and format are usually wrong. People say, I will just keep some cash at home. Then they do one of two foolish things. Either they keep too little to matter, or they keep it in forms that are hard to use under stress. History taught this brutally. In periods of interruption, small bills move. Large bills stall. Transactions fail not only because money is absent, but because change disappears. Merchants hesitate, and digital rails go dark before physical rails normalize. Bridge cash is transaction insurance. It is not an ideology. It is not a bunker fantasy. It is 1 to 4 weeks of ordinary household expenses in mixed small denominations, stored safely and discreetly outside the banking pipe. If your basic monthly spend is $6,000, your bridge layer might be $1,500, $3,000. maybe 6,000, depending on how rural you are, how dependent you are on digital payments, and how fragile your local infrastructure might become in an outage ones, 5s, 10s, 20s. Not because that sounds dramatic, because the point is utility. A household with $5,000 in small bills can navigate a short interruption very differently from a household with 200,000 trapped on screens and no way to transact. And I want to emphasize the harsh truth here. Yield complaints are irrelevant in this layer. People love to say, but cash at home earns nothing. Of course it earns nothing. A fire extinguisher earns nothing too. That is not why you own it. Now we reach the fourth layer. This is the layer almost nobody is taught clearly, and it is the layer that matters most. If your goal is to reduce locked door risk to the lowest practical level, I call it the direct claim layer. This is where you stop being a depositor and become a direct lender to the sovereign. The source document points to the forgotten American ancestor of this idea: postal savings, government-held deposits. No private bank standing between the saver and the guarantee in the worst banking collapse in modern American history. That structure held. The modern descendant exists right now through direct purchase of short-term Treasury securities. And this is where many people miss the point completely. They think the value is merely the yield. It is not merely the yield. The yield is a bonus. The real value is structural. When you buy a short-term Treasury bill directly, your claim is against the federal government itself, not against a bank that may be stressed, not against a broker you hope remains operational, not against an insurance fund that may become the center of a political decision during a wider panic. Direct claim. No intermediary door in the middle. That is the essence. If you hold $100,000 in a 4-week Treasury ladder directly, and the banking sector experiences a panic weekend, you are not waiting to see whether a bank opens on Monday. Your asset does not sit behind that door. That is not because the world has become risk-free. It is because you change the risk. That is the whole game in intelligent money management. You do not eliminate risk. You choose your risk with open eyes. The example here is very simple. A saver has $120,000 beyond operating needs. The lazy path puts it all in one high-yield savings account because the app is smooth and the marketing copy says FDIC insured. The disciplined path keeps maybe $12,000 in utility cash, $25,000 in structure cash, several thousand in bridge cash, and the large reserve in short-term treasuries purchased directly and rolled on a short schedule. Same person, same cash. Two totally different failure maps. That is what adults miss. Money storage is not just about amount, it is about failure map. The lazy map says one institution, one app. One comfort story, one door. The discipline map says multiple structures, multiple rails, and no single interruption can dominate the household. That is why I say most people do not need better opinions about the economy first. They need a better cash operating system. And before I give you the operating system in its sharpest form, I want to name one more mechanism because it explains why so many intelligent people still fail to act. I call it the normalcy drug. People do not wait because they lack information. They wait because yesterday looked ordinary. They wait because their card still works. They wait because no one around them is running. They wait because it feels embarrassing to prepare for something that may not happen this month. That emotional pattern destroys more households than ignorance. The public imagines financial failure as a sudden apocalypse with sirens and flames. Real failure often arrives as a sequence of small signals that ask you a humiliating question. Will you move before everyone else agrees you should move? Most people cannot do it. They need social permission, they need 3 headlines, 2 experts, and 1 bad personal experience before they change the structure of their cash. By then the time gap is gone. If you want to protect a family, a business, or even just your own peace of mind, you cannot wait for unanimous permission. You need a protocol. So here is mine. I call it the open door protocol. It is not a prediction. It is a stance. It says no single door controls my life. It says my spending money lives in the banking system, but not my entire future. It says one institution handles flow, another handles reserve redundancy, a physical layer handles interruption, and a direct sovereign layer handles serious cash that does not need to be trapped inside private balance. Sheet risk. It says, I do not worship yield at the expense of survival. It says, I do not worship convenience at the expense of optionality. It says, I would rather look slightly overprepared in calm times than look stunned at locked glass in bad times. Now let me sharpen it further, because protocols only work when they become concrete. If I were a young family starting from scratch, I would do this. I would pick one large insured account for my monthly financial plumbing, salary, and bills out. Cards linked, clean and simple. I would decide the amount required for motion, then cap it. I would open a second lane in a credit union or equivalent depositor. First structure and move true reserve cash there up to the amount that matches my emergency target. I would build a physical bridge layer in small denominations for short disruptions. Not because I think civilization is ending, but because electronic dependence is a luxury until it is a trap. Then I would learn the mechanics of buying short-term government paper directly and use that layer for larger cash I want liquid on a rolling basis but separated from bank. Door risk. That is not complicated. It sounds complicated only because the average household has been trained to treat one bank account as a complete answer. It is not a complete answer. It is one component, nothing more. And once the system is built, maintenance is not difficult either. Review monthly spending, refill the utility lane as needed, keep the reserve lane intact, check the physical bridge once in a while. Roll the direct sovereign lane on a short schedule that matches your cash needs. You do not need a Wall Street vocabulary to do this. You need discipline, you need humility, and you need to stop assuming the default structure is safe just because it is common. Common is not the same as durable. That mistake costs people fortunes. I also want to be honest about what this protocol does not do. It does not guarantee comfort in every macroeconomic scenario. It does not turn inflation into a myth. It does not protect someone who overspends, overborrows, and calls it optimism. It does not solve every market problem. What it does do is radically reduce your vulnerability to the very specific failure that destroys disciplined savers. First, the locked door. That is the enemy in this story. Not volatility in the abstract, not a scary headline, not a pundit with a chart, the locked door. And I want to bring the argument back to Warren Buffett logic, because people often misunderstand what my style of conservatism really means. They think conservatism means keeping everything simple in one place and trusting the old institutions because they are old. That is not my definition. My definition is simpler and tougher. Do not risk what you need for what you do not need. And if your household truly needs cash stability, then storing all of it behind one private institutional door is already a form of risk. It just happens to be a risk many people were trained not to notice. The best investors I have known did not survive because they were brilliant prophets every week. They survived because they were structurally hard to kill. That should be your goal with cash. Not impressive, hard to kill. I like that phrase because it cleans the window. A hard-to-kill household can handle a bank outage, a transfer freeze, a panic weekend, a payroll interruption, or a temporary digital breakdown without becoming desperate. A fragile household can have a large number on a screen and still be one locked door away from chaos. That is why I do not measure financial calm by balances alone. I measure it by accessible pathways. How many pathways can still function if one breaks? How many days can the family operate if the main lane stops? How much of the cash reserve is truly outside concentrated institutional dependency? Those questions sound severe because reality is severe. The danger with modern finance is not that it always fails. The danger is that it works so smoothly most of the time that people stop respecting the places where it can break. Smoothness is seductive. I understand the seduction. I like simplicity too, but simplicity that hides concentration is not simplicity. It is negligence wearing a clean shirt. The source material also hints at something psychologically important. When the old postal savings model vanished, ordinary savers lost not just a tool, but an idea. They lost the idea that the government itself could be the direct holder of safe household cash without a private bank standing in the middle. Once that idea vanished, the public was trained to think only inside bank-centered plumbing. That narrowed imagination is expensive because as soon as people forget direct claim structures, they start believing the only options are different flavors of the same dependency. That is not true. There are other lanes, you simply have to learn them before you need them, and this is where many viewers expect me to soften. They expect the reassuring part. They expect me to say the system is probably fine. This is all very remote, do not worry too much. Just keep living your life. I am not going to say that. I am going to say something more useful. The system may be fine for a long time. That is not the point. The point is that the cost of building a stronger cash structure is low, and the cost of waiting until structure matters is potentially catastrophic. That asymmetry is enough for me. It should be enough for you. If a roof repair costs little today and a collapse costs everything later, intelligent adults do not wait for rain to prove the roof exists. They fix the roof. The open door protocol is your roof. And I want to push one last identity flip before I close. If you store all your cash where it is easiest, you are not being calm. You are outsourcing thought. If you build layers, you are not being fearful. You are acting like an owner. That is the difference between a consumer of financial products and a steward of capital. One buys comfort stories, the other builds systems. I know which identity I prefer. I know which identity kept more people standing in 1929, and I know which identity I would want if the first real stress signal of this decade turns into the second, and the second turns into the third. And suddenly the debate on television becomes a sign on a door in your own town, because that is how these things happen. First they sound theoretical, then they sound political, then they sound temporary, then they sound local, then they sound like somebody else's problem. And then one morning they sound like your debit card failing, your transfer pending, your payroll delayed, your app frozen, your branch closed, your cash stuck, your options narrowed by the hour. That sequence has happened before. That sequence will happen again somewhere. The only question is whether your household is built to care less when it does. That is why I do not want you chasing the highest yield on spare cash before you solve the door problem. I do not want you confusing a government insurance label with a complete plan. I do not want you measuring safety by familiarity. I want you to build in layers until one interruption cannot control your behavior. That is the standard. And it is a hard standard for a reason. When stress arrives, you do not rise to your intentions. You fall to your structure. So build the structure, build it while the doors are open. Build it before the crowd remembers history. Build it before the next expert tells the public everything is contained. Build it before the language of abundance of caution starts appearing in press releases. Build it before your own mind starts bargaining with convenience. Because once the locked door becomes visible, the best move is rarely available anymore. This is not about living scared. It is about refusing to be surprised by an old machine that has been giving the same warning for nearly a century. A bank can be useful. It cannot be your whole answer. Insurance can be valuable. It cannot be your whole answer. Physical cash can be helpful. It cannot be your whole answer. Even direct sovereign claims are not your whole financial life. But together, arranged with discipline, these layers can do something extraordinarily important. They can prevent one failure path from owning your future. That is what the people who survived understood. They did not necessarily know the exact day the trouble would arrive. They knew something better. They knew not to stand behind one door. So here is my final instruction. Go look at your cash tonight. Not your net worth, not your retirement fantasies, your cash. Ask where it sits. Ask what structure it depends on. Ask how many doors control it. Ask how long your household functions. If one door does not open tomorrow, if the answer embarrasses you, good embarrassment is cheaper than regret, then build the 4 layers. Utility cash for motion, structure cash for redundancy, bridge cash for interruption, direct claim cash for serious reserves that should not be trapped behind private balance, sheet risk. That is not an academic framework. That is not a blog idea. That is an operating system. And in my experience, The families that survive hard periods are rarely the ones with the most elegant opinions. They are the ones with the cleanest protocol. I will leave you with the image I started with because it is the only image that matters. A locked door. Everything in this story turns on that image. If one locked door can stop your life, your cash is not safe. It is only sleeping, and sleeping cash wakes up too late. Move while the door still opens.